All right. Good afternoon, everyone. This is Ben Thorpe with Farm Equipment Magazine. Welcome to our latest webinar in conjunction with Keiko Isom. Today's presenters are Clinton Baker, principal at Keiko Isom, who focuses on the distribution industry and specifically with equipment dealerships, transportation companies, and beverage distributors, and Ryan Dreyer, senior manager at Keiko Isom and a CPA who is adept at audit reviews and compilations of financial statements, and has specialized tax planning knowledge and in-depth experience with multi-state taxation. Now, before they get started with the presentation, we have a couple things to go over. So if you look on your screen, there is a control panel at the bottom with a little Q&A icon. You can submit questions there at any time during the presentation, and I encourage you to do it as you think of the questions, because then they'll kind of backlog at the end, and then time permitting, we will look to answer as many as we can following the presentation. And we are recording this webinar, and there will be a replay available of it for everyone who registered afterward. So with that, I am all done, and I will turn it over to our presenters. Thanks, guys.
Great. Thank you, Ben. We appreciate it. And we always appreciate the partnership with you guys and the opportunity to present. So today's topic here, how do you make your dealership's audit or review more valuable, is very, very timely. This is the time of year when most calendar year equipment dealers are getting their audit or their review done. And we're just, instead of saying audit or review all day, we're gonna focus on just the word audit. If there's an exception to what we're talking about that applies to a review differently, we'll use that. Probably one of the first questions we get from people is, are we talking financial statement audits or tax audits? Because they are two very different things. Today, we're going to talk about financial statement audits, where you hire a firm, CPA firm, to come in and look over your records and issue an opinion. And Ryan and I are both with the firm Keiko Isom. And so one of our other presenters today that many of you know, Mark Johnson, is unfortunately not available. When we set this up, Mark didn't realize he had a conflict, that he had to be on an airplane today. So not a problem. I think many of you have heard Ryan and I speak either here with Farm Equipment or with other organizations. So if you get a copy of our slides or want to grab a screenshot, here's our contact information. Working in this industry, we field a lot of questions from not only clients, but just other friends in the industry like all of you, and are welcome to hear what you have going on. And we'll be glad to kind of share with you what we're seeing going on across the industry. Before we get started, I do want to share on the next slide here just a little bit about our firm. And so Keiko Isom might be a firm name familiar to many of you. If it's not, we are an accounting and consulting firm. So Keiko Isom is the accounting side of our business that issues audit reports, things like that. Pinion is the side that we brand our consulting services under. And the two are almost of equal size, but we're about 450 people. What really makes this unique as a firm is being a firm in the top 100, but yet we focus on closely held businesses, many of them family-owned businesses, but certainly closely held businesses instead of public companies. But specifically, we focus on the food and ag industry. On the next slide then, within food and ag, we really define that as everything from policy to plate. So some of our consultants are lobbyists and are on the Hill in Washington, D.C. Many of our colleagues within the firm may work with ag producers. So many of possibly your customers are the same as our customers. And then we have other parts of that supply chain from policy to plate around food and ag, such as our equipment dealer group. And so the map you can see here, the states that are in yellow are states where we have an office as a firm. The states that have a green tractor in them are states where we have an agriculture equipment dealer who has locations in those states. Not all of them are of a green color, I'll assure you of that. But then also we have where there are yellow dozers are then where we have construction equipment dealers or distributors, often as they call themselves, in those states where they have locations. And so it just kind of gives you a breadth of the size of the practice that we have. Certainly we cover the entire United States. As a firm, we go larger than that, but our equipment dealer practice is really focused on the U.S. So on the next slide then, wanted to share a little bit about what we do. So we're going to talk about the second check mark today, audited and reviewed financial reporting. That's our main topic. But we do the things that other CPA firms do also for equipment dealers. We do tax planning and preparation. But then after that, we get into some pretty specialized areas that many of you may have heard us speak on before around valuations, mergers and acquisitions. That's still a very relevant and very timely topic. Even in the midst of COVID, we've still continued to see a lot of deals happen across the country. They've just changed a little bit. And then we do a lot of industry benchmarking. You can see some of these other check marks that we do here. So on our next slide then, want to turn it over to Ryan. So Ryan, by background, again, some of you may have heard Ryan present before, but Mark and I oftentimes when we're out talking with you, you may have heard us refer to the Ryans back in the office. So we have two Ryans in our group that are our senior managers and soon to be principals. One of them is Ryan Herman, and one of them is Ryan Dreher. And so today I'm here with Ryan Dreher, who I've known since he started with our firm, I think 11 years ago now, 10 years ago, something like that. But Ryan, why don't you take us through these next couple of slides here? A lot of people maybe have some misconceptions about an audit, about why they have it, what they don't like about it, and things like that.
Sure. So yeah, why does your dealership pay for a CPA financial statement audit or a review? In the US, non-public businesses are not required to have an audit. In Canada, though, if you have over 250 in gross revenue, it is required unless all the shareholders of the organization sign off to not have one. But then a lot of you on here do have audits, and that may be because your OEMs require it, because they generally require an audit if you have over 100 million in revenue, or a review at the 50 million mark. They are normally your first right, based on guarantees and stuff that you've signed in your dealer agreement. So that leads me to the lending institutions on the next one. They tend to require it if you have 5 million plus in lending, so like on a line of credit or a floor plan that you have open with a local bank. So they require it at a lower dollar amount, mainly because they're second right. So they want to make sure that that gets taken care of and everything's good so that they still would get their money back. Then
hey,
you
Ryan?
Yes.
Hey, I want to interrupt you for just a second. I just realized we kind of, you and I speak in terms of audit reviews and compilations, but for some people on the phone, can you just give them a quick difference of what is an audit versus a review? Sorry to put you on the spot. We didn't plan on this. Yeah. But when I saw it in writing, I thought I better ask you.
Yeah. So an audit is when you have an independent CPA firm that will actually issue an opinion and say that we've tested all these transactions and we've obtained reasonable assurance that these financial statements are free from material misstatement. That's that line you see underneath on that next bullet that we were getting ready to talk about. Then for a review, we do not issue an opinion on there. We versus confirming balances and making sure everything is correct at that specific date and time. We do some analytics and ask you some questions to make sure the year over year changes look normal and that we don't see anything that's materially some big incorrect amount in relation to GAAP reporting. So those are kind of our differences between an audit and a review. Is one has an opinion and we can say that, yes, at this point in time, there was no material misstatements. The other one says, we've looked at it and the trends seem to line up with what GAAP says and what they've been doing in the past.
So the review is a lot less in scope, probably a lot less in, not probably, I know it's a lot less in cost to the dealer. Generally, though, when someone grows from a review to an audit, because maybe they hit those thresholds you've mentioned here, even if they drop back below, they don't normally go back to a review unless they're below that for several years, right? They usually, once you do an audit, a lot of companies just say, you know what, that's our process. We stick with that, right?
Once you've got through the first year of pain of an audit, it's easier to stay as an audit. In case you ever have to go back, you don't have to go through that pain again.
Yeah.
Yes. Down here on this next bullet point there I was getting to is that, that you hire us for an independent third-party look. So we look at accuracy and it's supposed to, come from a credible accounting CPA knowledge source. So again, when we're talking about reasonable assurance, material misstatement, depending on your level of revenues and stuff is what we determine our materiality on. And so we if you have over 250 million of revenue, you can have $1 million materiality levels. So things can be underneath that could be wrong, that we may not show up, or we can still say that there's not a material misstatement because it's under that threshold. Another part of our process is when we go through here, we look at internal controls. We don't look at designing them. We look at what's out there, and we can kind of tell if there's any weaknesses in the internal controls, and then we can give recommendations on how to improve those internal controls.
Historically, Ryan, isn't it pretty much every, at the end of an audit, like we give a management, or we give a letter back to the board or the shareholders and management, and we identify things in their processes that they can work on. I would say this: in my 20-some years of practice, I don't know that I've ever seen an audit that didn't have that letter that said you need better internal controls, at least in a closely held business. I mean, right. Yeah, you get to big publicly traded companies, they have enough people and processes to do that. But that's pretty common from what you've seen also? Correct,
because this, a lot of them are kind of small, and they maybe have 1 or 2 people in their accounting department that we do stuff for. So it's hard to have a big separation of duties, or have, a lot of things are done without, like, in verbal approval versus having shown in an email or a piece of paper that they wrote and stamped on, those type of things. And so it's hard to show that those controls are in place or working when there's nothing to go back and look at. Right.
And this, this reasonable assurance concept is one also that I think for people that maybe aren't as familiar, don't have a degree in accounting or CPA background, is one that I think we get a lot of questions about, especially from dealer principals. So a lot of times the CFO, the controller, the accounting group might understand, okay, reasonable assurance means we could still have some, as you said earlier, immaterial misstatements that the size of dealerships, those might be millions of dollars. But from an owner's perspective, they hear, wow, we're off by $1 million on something. Right. Now, what I would also say, and we're going to talk about this a little bit later, most of the dealers we work with, they don't even have those kinds of things, because they call us throughout the year and say, hey, what should I do with this? As opposed to waiting and finding something in the audit. Well, we'll talk about that more later. I have a couple of kids. One's a senior in high school and one's an 8th grader. And the other day we were they were asking kind of, what do we do? Our son's thinking about going into college, going into business college, maybe accounting. And I used this term reasonable assurance out of my 14-year-old daughter, kind of, what's that? I tried to explain it. She goes, Dad, you can be reasonably assured my room is clean. I thought, there is no way in the world. That's not an immaterial difference, trust me. So it's kind of funny language, but it's a key phrase, when people are thinking, what value do I get from my audit? Just realize the value of the audit. You're not getting perfection. You're getting a reasonable assurance that there's no material misstatement, right? So why, Ryan, on our next slide, I think you have that set up, why do people hate paying for the audit?
Yes. Well, main one, audits are more expensive than a review, like you touched on before. So dollar amount out of your pocket. But more importantly, it's the disruption dollars of how much time your accounting staff is preparing the work papers for the audit, making sure that the internal books are in place for us to do the audit, and then getting that all uploaded, us taking the stuff, starting the audit process, and then coming back and asking questions, and why does this not tie, or these different things that then disrupts your accounting staff for probably that 2 to 3 month period after you've closed your books for the year. So that's one of the other things on this list of why do you hate to have the financial statement audit, is timeliness. Is the audit gets completed 2 or 3 months after year end. And so then they go back and start looking at January, and trying to get those months closed out, so that it's not very good to go back. You can't keep looking forward without that. An audit is not designed to detect fraud. Some people are under that notion that an auditor is going to come in and they'll find out any fraud that you have. So again, that brings into that materiality limit, like what we're looking at now. If we find fraud during one of our procedures, we will report that and discuss that with you, but we're not set out to designing a whole bunch of audit procedures around detecting fraud.
I think that's also a lot of times a miscommunication or misunderstanding among employees. For one thing, the term audit gets used a lot of different ways.
Right.
We're talking about a financial statement audit. They might think somebody on behalf of the OEM or really be on behalf of the floor plan lender coming in and checking inventory. They might refer to that as an audit, or somebody else coming in, maybe not in the equipment dealership space, but I'm thinking a lot of other businesses, maybe have somebody come in and do routine cycle counts, and they call them audits. And what's interesting is, like, what we're doing is really, to your point, is a financial statement audit. It's not designed to detect fraud, although it does occasionally.
Yeah, sometimes it does find stuff. And then we report that right away and say, hey, this looks off. How do you want to deal with this? And let you guys take that part from there. And then, like we said before, materiality, it's can be a high dollar. So there's a potential that we will miss a lot. We don't know where things are buried. We're looking at this dollar threshold, and things under that we don't have to worry about because it's still materially correct on your financial statement. Cutoffs, those can be difficult too at year ends, of making sure you have all your accruals made, any contingencies booked that you have, or even what the measurement date is at that time. So, like an example, like your OEM statements come in, and they're normally, the statement cutoff is 2 or 3 days before your actual year end. So then trying to come up, you guys do a lot of business in that last 2 or 3 days, and trying to make sure you get all that reconciled on your books between the inventory and floor plans. It's just hard. And that's stuff that, we have to make sure that you're doing correctly, but then you have to spend all that time to get that right before we come out and audit. And then some of the values on your financial statement are some version of cost versus fair market value. And then, of course, you have us as independent CPAs. We're not allowed to do a lot of the bookkeeping and cleanup for you. So it's easier for you to ask during the year of, hey, is this how I do this? Or do you have a suggestion on this? We can give suggestions. We just don't want to give you the cleanup and bookkeeping entries because we don't know a lot of the stuff that's going on inside the business, where things can be buried in there. So we want to make sure that you guys are the ones doing all that bookkeeping cleanup so we can remain independent.
Yeah, in fact, there's even for those people that are on the call that maybe didn't come up through public accounting, the way you and I have, part of our process is in there. We even have to, I don't want to say give an opinion. That means something else in what we're talking about here. But we basically have to come to a conclusion that the staff who are responsible for these financial statements, the controllers, the CFOs, the owners, that they're competent, right? I mean, because if they're not, we actually can't issue a report then. So part of that is what you're hitting on here is it's easier for them to pick up the phone and call during the year and say, hey, I've got something unusual. What suggestions do you have, or what questions should I ask? Or here's what I'm thinking about doing. What do you think of that? Those types of conversations are fine. It's, when we find, when we're out there in February and we find something from 6 months before, and the person didn't realize it was wrong. I also want to touch on this before we move to our next slide here. I want to touch on this. Values are generally some sort of cost instead of fair market value, or versus fair market value. And I want to touch on this because, again, this isn't a merger and acquisition presentation, but certainly financial statements, audited financial statements, are key to maximizing value in a merger or an acquisition deal. And so this idea of they're the cost basis. So you went out there and you bought something and you've taken depreciation on it. It's gone down in value on your books, but the reality is maybe it didn't go down that much, or maybe it went down more. I would say larger dealers understand that pretty well. They don't really have a hard time when they think about value. They don't go immediately to say, well, let's go look at my balance sheet and see how many, what's my equity. They understand that valuations are generally based upon EBITDA from the past, a multiple of earnings from the past, or discounted cash flows, which is a multiple of earnings in the future, and then kind of a weighting across those two with the balance sheet somewhere in the middle. Like, they understand that. It does seem like a lot of smaller dealers do have a tendency to go back to what is my book value and what multiple should I put on book value. It's not wrong. Everybody, when it comes to valuations, everybody kind of has a different approach. We certainly see some consistency, and we do enough of the deals. We help set consistency for the industry. But, this idea of my balance sheet does not represent the value of my company. Across the board, equipment dealers are worth more than their balance sheet would say. So just want to reiterate that. Also want to remind people, if you have questions about anything, Ryan and I have mentioned, or maybe we didn't spend as much time on a topic, then feel free to type those in the Q&A button down below. I think Ben's going to kind of watch that Q&A. Ryan and I will also. And we've got a couple of questions I think were submitted ahead of time, even that we have some time to get to at the end. We certainly will. So we've talked about what an audit is, bigger in scope than a review. We've talked about, what it's not. It's not designed to detect fraud. It is expensive, but the disruption cost is bigger than that. So one of the ways to make an audit more valuable is to minimize that disruption cost. So Ryan, when you started in your career, typical field work. So typical accounting firm says, I'm going to come out and audit an equipment dealership. They probably want to show up on December 31st and count inventory, or plus or minus a day. But then when they come out in February, how long would they have been there typically?
It could be 1 to 2 weeks in the field. That is the typical audits, what you would see. It's hard for me to remember that anymore, just because we're so different from how we're doing our audits now from when I started.
Yeah.
Like now we're going to get into how we can do this later, but we're doing year-round auditing now. So now we're doing inventory counts throughout the year, so we don't have to be there on 12/31. Our audit field work, we're there for 2 days. And a lot of times now we're doing those remotely versus having to go in the field. So it's a lot less disruption on your people at one specific period of time. It just has, a couple hours throughout the year versus, having a whole 2 weeks blocked off that they can't hardly do anything else at work. So that's why I was like trying to think back. How did we used to do the audits? Because I'm so out of that mindset now.
I've been around a bit longer than you.
Yeah.
I will tell you, I remember early in my career, you described it perfectly right. It was 4 or 5 of us going out to a client's place for 1 to 2 weeks, depending on the size of the audit. Right. And what's interesting was I was just at a conference last week and talking with some equipment dealers, actually doing a very similar presentation here. And one of them, right before the session, we were just making small talk. And she even said, yeah, I'm glad I got to come to this conference. She was a CFO. She said, my controller's back in the office. Our auditors are here this week and next week. And I kind of laughed. I said, you're going to want to pay attention to today's session. So let's start going through some of these next several slides then of how do you approach auditing to bring more value to it. I forgot we have this slide in here.
You got to talk about the different kind of opinions on the financial statement audits.
Right. Yeah. I'll run us through this pretty fast. Again, for those of you that maybe don't have the background as a CPA here, a clean report, that's the green. That's what we're wanting. In our industry is known as an unqualified report, which has always sounded bad to me. But the qualification there just means there's no exceptions. So it doesn't say everything's good except XYZ. So if there's no except XYZ, then you're getting a clean report, which is called an unqualified. We call it an unmodified, just kind of amongst ourselves report, which is really what you want. A qualified opinion is very similar. What it would say is everything looks good except. And maybe it's an except you've decided to not follow generally accepted accounting principles on a topic. This came up in the industry over the last 10 years. There's been a push for the new lease standards, which, by the way, you're subject to right now. If you're on the call and you've not talked with your firm about the new lease standards, you're behind. So ask them about it. It'll be fine. But it's taken about 10 years from the time those were supposed to be enacted to when they were. And it went through a number of iterations of our closely held businesses, like many of you on the phone today. Are they going to be subject to these rules or not? And it just kept getting pushed every year. Finally, financial accounting standard boards put their foot down and said, yes, it is. And there was a lot of discussion in the industry about going ahead and taking what's called a qualified report, which means everything is good except, and the except would have said the company, or could say the company has decided not to follow generally accepted accounting principles on accounting for leases. That's an example. What I would say is I've rarely seen one of these in my career. They certainly do happen, but rarely have I seen one of these. Fortunately, what we have found is those lease standards are not nearly as complex or hard to follow as people initially thought. They're not easy, but they're not as hard or maybe as bad as people thought they were going to be. And so this idea of taking a qualified report kind of went away. The concern on a qualified report is, you might be talking to your CPA firm about that and say, hey, we just don't want to comply with something. Can we just not do it? They say, yeah, qualified report. The issue is probably in every one of your lending covenants, there's probably something in there that says you have to have an unqualified report. In other words, a clean report in accordance with generally accepted accounting principles. Or what happens is, this, or this. They might have a right to call your note immediately. Probably wouldn't happen right now. I think lenders are pretty willing to lend. You guys just can't get the inventory to need their money right now, which is a whole different topic, whole different seminar. But that would be the only issue, is if somebody were talking about doing that, just know your covenants probably say, hey, there's an issue here. The other two types of reports, honestly, they just don't happen. One of them is called a disclaimed report, where the accounting firm actually issues a report that says we are not putting our name on there. This is something that I've never seen it in practice or in person. You read about it once in a while. I do think here just recently in the news, we have a former president's accounting firm who has come out and says you can't trust any of the financial reports from the last 10 years. I don't know what that's all about. I read the headline, didn't care enough to read the article. But that was basically them disclaiming, saying, don't hold us responsible. An adverse opinion is one that just says these things are flat out wrong. And again, those never get issued, because then what happens is the firm just disengages. The client doesn't want the report out there. The firm doesn't want the report out there. So that kind of a quick summary here. This next slide talks about, gets into what Ryan and I were talking about how do you make the audit more valuable. The traditional method was to do a lot of substantive testing. And so substantive testing is when the auditors would show up out in your office for 2 weeks. They would go through a bunch of transactions. They would use random number generators to find out certain transactions to look at. And they're just going to go transaction, transaction, transaction. They don't care about your controls. In fact, they default to say your controls are worthless. And so therefore they do more testing. Very tried and true, 100 years of industry practice saying this method works. The problem is just as Ryan said earlier, it provides no predictive value. It's always looking backwards. It doesn't help make operations more efficient. And so what's happened is in the last 15 years, I'm going to say maybe 20 years early on, is a number of firms have said we need a newer way to do auditing, a more progressive way to do auditing. There are still less than half the firms out there really doing this. And I may be high on saying if they're even half, it's probably less than a fourth still, that are saying instead of doing substantive testing, we're going to do control testing. Control testing is really where we go in and understand what is your process. So when someone comes in to buy something from you, just as an example, what's the process? What should happen along the way? And then what we do is we test those controls. So we go back to see was the process followed? Not the substantive test that says, do I have the right purchase order and do I have the right number here? No, it's the right process. Who are the people involved? If they didn't do their job, what bad things would happen? Can we rely on their controls, their built-in internal controls in the company? And so that's really designed to not only find if something didn't go right, but actually to help prevent it from going wrong in the future. So Ryan, let's move on into these and have you share. Why don't you talk a little bit about internal controls and audit function, that sort of thing?
Yep. Yeah. So that's how I was talking about before, how we were able to do inventory observations during the year, as we started testing the controls of our dealerships over inventory. So if they're doing counts throughout the year, and they're able to document those counts, when the purchase order comes in, there's people are approving those purchase orders before they get ordered, and approving it once the inventory is received. And we can go through and see all of these documentations of these approvals and controls along the way. Then we can say that they're working correctly, which then means we should be able, then we can count at any time of the year and inventory is going to be correct. So as long as that's working out throughout the whole year, your inventory in June would have the same controls that your inventory in September or December had. So we can count at any time and don't have to be on that specific day when you're doing your old counts to adjust all the inventory to actual. And then it catches mistakes or errors more timely. So if we do an inventory observation in May and we find some things that aren't matching up with what the count is, you say, hey, what's happening here? And then they can go through and figure, oh, this is what control broke down. Look, we can go in and fix that right away. How we've detected some fraud with these during the year audits, because picking different things that people didn't think we were going to be counting, because they knew when their company counted, but they didn't know when we were counting. And so coming out in the middle of a year counting, we found some like parts boxes and stuff upstairs that, yeah, that's all there, but you go and you kick the box. No, there's nothing in that box. So we found things like that going throughout the year. And then it stops any bad processes from continuing and allows an insertion point for other team members to achieve separation of duties. So we can say, hey, you have this person approving the purchase order and receiving the inventory when it comes in. Have those be two separate people. So then we can, rely upon that control, saying the person that ordered it, it should have been ordered. And when it came in, another person said, yes, this was ordered. And so another question that kind of brings up is, should you have an internal audit department, internal audit function? So what would this internal auditor do? So they could do those counts throughout the year. They could go to your different locations, count, reconcile your petty cash throughout the year, look at fixed assets at each location to keep your fixed asset listing up. And then if you have that reporting to the correct person, someone on the board or someone outside of the financial accounting function of the business, then even the auditors like us, we can rely on their work and not have to do that. So that if we don't have to do that work, then your audit's cheaper and there's less disruption time for your audit department because that's already been done by your internal audit function.
Yeah, one of the other things that's nice about the year-round auditing, as we call it, that's built into this slide here about testing controls is the other thing is it's also more efficient because it doesn't then just rely on the finance, the accounting staff, the administrative staff, but a lot of times what we actually do as we're doing inventory throughout the year, we do it electronically, using FaceTime or whatever, that person's, I'm an Apple guy, so to me it's FaceTime. I did see the other day that
FaceTime or Zoom.
Or Zoom. Okay, thank you. I don't even know what the other method is.
Yes.
I did see the other day that supposedly now you can download FaceTime even on an Android. But anyway, I don't know about
so
that.
You use the parts manager to count the parts, or you use your sales guy to go out and count your field inventory. So you're getting other people involved that's not your accounting department, so they can still keep focusing on keeping the daily operations going and your internal financials up to date.
Yeah. And even like with the sales team, we schedule that, when they're in their downtime. I mean, clearly, if they've got something going on, we don't want to interrupt a sale, which is also the beauty to me of developing the right internal processes is it isn't an accounting function stepping in saying, here are the 10 things you have to do in this process. It's really developing that with the operations people to say, how can we have good financial internal controls, but at the same time, make sure we're still having a great customer experience? How do we still make it easy to sell iron to customers, right?
Right.
All right, let's look at this next slide here, Ryan. What are some other ways to get more value out of your audit? So one of the ways is to make it a conversation piece. And so this becomes a thing where I think, again, and I'm not disparaging small dealers, but I'll say larger dealers, we tend to see them dig into their audit a lot more. We tend to see them want to have discussions about processes and making those better to get more value out of the relationship with their auditor than the smaller dealers. Smaller dealers kind of have a tendency to look at their financials, be like, okay, yeah, we had a great year. No, we didn't. Um, Smaller dealers do tend to use their audit function and their auditor relationship more from a tax perspective. We'll talk about that a little bit later, but the point is make it a point of discussion. And so not just we got the report, can I get a PDF copy to send to my lender? Don't just make it that. Make it actual, like, let's sit down, let's go through it. Help me understand, where am I getting better? Help me understand where are the areas that maybe we're giving up ground. So one of the things that Ryan and Mark and I and the other Ryan do with our teams is we then go meet with our clients once a quarter. And we certainly don't do an audit once a quarter, but when we go out there once a quarter and can sit down with them and look at year-to-date financials and rolling 12 financials, it helps give us a picture of where they are throughout the year, where they're going to end the year. So that's part of our audit process. That's why another reason we don't need to spend 2 weeks or a week or two out at their office in the springtime is because we've been out there during the year. We understand where they're going. But this audit report becomes a conversation piece to have that conversation. We also then start to break down into key performance indicator analysis and trends. So if you're a smaller dealer, there's some really good information out there through the cost of doing business report that you can look at compared to the industry as a whole. If you're a larger dealer, that report is a little skewed towards the smaller dealers, but it's still good information. What we do is we actually obviously take the names off, but when you work with 40 to 50 equipment dealers across the country, we can come up with aggregated data within our own group of high performing dealers to benchmark against. But ultimately, the best benchmarking or KPI analysis and trends is looking at yourself and saying, where are we trending the right direction? Are we giving up ground in certain areas? An audited financial statement probably isn't going to go into enough detail to do that. But the fact is, you're auditors and you have the information to do it. We basically break the dealership down into its 5 sections, right? New sales, used sales, rental, parts, and service. Just simply getting into those 5. All of a sudden, we can start to look at margins. We can start to look at turns. We can start to look at, admin compared to all of that. That's the fancy word for that is absorption, would be fixed expenses to aftermarket. So just parts and service, rental. But the point is, like, there's all kinds of analysis that can be done. Your audit, if you want to get value out of it, don't just say thank you and put it on a shelf or save the file somewhere on your desktop, right? Actually use it. Let it be a conversation piece. It's probably not a conversation piece you're going to use every week, maybe not even every month, but maybe once a quarter. If you use it more than too much more than that, I think it probably just becomes you're rehashing old stuff. But anyway, let it drive the conversation. So how about our next slide here? So one of the other things about the audit here is these first couple of bullet points here. The audit practices incorporate, they're measuring your quality of your quality of reporting within the organization, and the financial side of that is just one piece of that. Predictive analysis and benchmarking, we kind of already talked about that on the last slide, but I want to hit this third bullet point down here, and that is take the same approach that we have with our audits into other areas of our business. So when an auditor is going to come in and look at your financial statements, there are times a year where you kind of get things cleaned up, right? Before they get there. What's your backstop to do that on HR compliance things? That's not part of your financial statement audit, but what if you had that same approach and said, hey, we need to make sure we're going through once a quarter and just kind of cleaning up HR files or cleaning up our compliance. Let's make sure we have everybody's documents that we need, et cetera, et cetera. That one I think has been around for a long time, but having the same attitude about that area as you do about your financial statement health is pretty important. These next two are two that we're seeing emerge in the equipment dealership space and a lot of other spaces along the food and ag continuum. In fact, probably more in some other areas, but they will come to equipment dealers. One is the area of sustainability. And so Probably for some people on the call, you think I just jumped to hugging trees. That's not what we're talking about here. But sustainability is really, there is an environmental component to it, but it's also really about how do you make sure your business itself is sustainable. So sustainability, yeah, we can come up with a carbon index score for you. Again, that's not the KCO ISOM side of our business. That's not the audit side of our business. That's the opinion side. But I mean, there are people out there that can do that. And someday you'll be asked for it. I'll come back to that in a minute. But the area of sustainability is really looking at how do we make sure that the business model is sustainable? Are we aligned with the right strategic partners, the right OEMs? Some of you don't have a choice. Some of you have been pushed. Brand purity has been pushed on you so much you've got your one. Others of you carry multiple brands. And how do you analyze and make sure the ones you're aligned with are the ones that are going to be there long term? What are you doing from a workforce development perspective? And what are your sustainable practices there? How are you developing talent? Some of you can influence that. Some of you are kind of on the receiving end of whatever happens. But even if you feel you are, there's still things you can be doing to develop your workforce. What about your management team? From a succession planning perspective, everybody wants to talk about it. Nobody wants to do it, until you get right up to crunch time. And that's not true. More successful dealers do deal with it ahead of time. Ownership also is an issue about sustainability. Some of you are with OEMs that actually all of you are probably with OEMs that have to approve who your dealer principal is. Some of you are with OEMs that are more restrictive on that than others, but what are you doing? So sustainability is an environmental thing, but it's also more than an environmental thing. What we're seeing happen in other parts of the food and ag chain is we are seeing large companies come back to those food producers, those food processors, I should say, who are then going back to the food producers and saying, it is an environmental thing we need to understand from all of you. It is a management succession issue we need to understand from you. And if you want to do business with us, you have to tell us what your plans are. Doesn't mean you have to have things perfect, but you have to tell us what your plans are. And what's going to happen is at some point, the OEMs are going to get pressure put on them. Somebody's going to come to, Case or John Deere or somebody at JP Morgan or, some other rating company who's looking at their stock, and they're going to say, hey, you have a lot of money borrowed yourself so that you can manufacture these things, but your distribution channel you don't own. You do that through contracts with people. Just like with the financial statement audit, where for years they've said, how can I trust these people? I'm from Indiana. How can we trust these people in little Podunk, Indiana, that we don't even understand from our big high rises here in New York City? How can we know that the people you've loaned money to sell your equipment are going to be there? They're going to ask that question about other areas too. They're going to start to say, hey, if you want to be in alignment with us, then you have to have a certain, maybe it's a carbon index score, maybe it's a diversity and inclusion score. And by the way, your distribution network has to have it also. It's not at the doorstep right now, but taking the way you make your audit more valuable is you start taking that audit approach into these other areas of your business, because those days will come. They're not here right now. I've not heard that from anybody in the equipment dealership space, just to be clear, but those things will come. We're seeing it in enough other areas. If you're on the construction side of equipment dealers right now, as opposed to the ag side, I would say this, we're not seeing it nearly as much there. It will happen. Will it happen, in my remaining work career? Possibly on the construction side, definitely on the ag side. In Ryan's continued work career, definitely on the ag side, probably on the construction side. But anyway, it's one of those topics that we've had conversations with equipment dealers about how do we incorporate that kind of data into our audited financial statements. We don't have anybody doing that right now. Our recommendation to them has been, if you're interested in doing some reporting on your HR compliance practices or your sustainability practices or your D&I practices, probably your audited financial statements aren't the place to do that, but there are certainly reporting mechanisms out there that, again, like our consulting side of our business called Pinion or other firms can help you do. So Enough about that. I'm looking at the time here, Ryan. It's about 15 minutes. Why don't we hit? I think we only have one or two more slides, and then that'll maybe leave us, 5 to 10 minutes for in case questions have come in through email. I don't see any in the chat, but Ben might have a couple.
Yep. Yeah. So this next part is just kind of talking about your journal entries and kind of the period 13, and that's kind of a yellow flag, but it's better than a red flag. So you'd rather have some period 13 adjustments than audit adjustments, but you would like to have everything, in your normal either operating transactions or your period closing transactions. So as an example, if you yearly are writing down your used inventory and you're putting that in period 13, so it doesn't mess up your normal monthly operations, you should really try to write down that used inventory monthly, because when that reversal comes out, when that used equipment is sold, it messes up that period that it was a period 13, that is what you put it in, and now it's coming back out into one of your normal periods. A lot of times our audit AJEs do get put in period 13, and I'm not saying audit adjustments that you expect your account to make. There's few entries that you hire us to do, like income tax accruals. A lot of times that gets done, and that's one of the audit adjustments you're expecting us to make. It's other adjustments that we find that then we have to report on to the board. And if there's too many of those, it makes us think, okay, do they have the experience necessary to prepare financial statements? Are these good? And so then that gets back to Clinton's audit opinions side of things. So that's just try to make as many of your period 13 adjustments as you can throughout the year, so there isn't a lot of period 13, because that's one thing that been told on the IRS side is they always request the period 13 adjustments. As an auditors, we always look at the period 13 adjustments to see if there's something unusual in there that's happening that shouldn't have been done throughout the year for cutoff reasons.
Ryan, you mentioned used inventory write-offs. Nobody's writing anything off right now, man. It's their questions are all, can we write them up, right? And the answer is still no on that. Is that right?
Yeah.
That's
exactly.
Funny. Everybody right now is just wishing they could get inventory to sell, huh? All
For
right.
sure.
On our next slide here, just some more benefits to better internal reporting. So really what Ryan and I have been talking about is, how do you make this more valuable? You make it more valuable by doing it throughout the year, not just at the end of the year. That also makes it more or less costly on your distractions to your operational team. It also gets more people involved in the process by using parts managers, sales managers, that sort of thing. It makes it a conversation piece throughout the year, so it also helps prevent things from happening when people know, okay, I don't just have to think about this in December. But then that year-round approach and it being a conversation piece also has some other benefits. One of them is it makes a lot more effective tax planning. Like I alluded to earlier, we kind of see two schools of thought on this, and it generally does follow size of dealership, although not always. But generally, larger dealers are probably less tax sensitive. Nobody wants to pay more than they should. I will say that up front. But a lot of our larger businesses, they do just kind of see it as it's a cost of doing business. I'm not going to let tax decisions drive how I do operations. And I know I'm going to have to pay it. I'm going to have to pay it now, or I'm going to have to pay it later, but I know I have to pay it. So just help me pay less now, but I understand it. Some of our smaller dealers are much more tax sensitive, much more about doing, adjustments like Ryan was talking about at the end of the year, or doing other things to help reduce taxes. The fact is, better planning throughout the year is going to help you do that, no matter which camp you're in. It also helps understand better cash flow, which, when we built these slides here, we put better loan terms. Right now, everybody's loan terms should be really, really good. Nobody should be struggling with that. But it does help you do better cash flow planning. I was talking with somebody the other day, and they were talking about, I was talking about forecasting. They were talking about forecasting as well. And then in the conversation, we realized we weren't talking about the same thing. They were one of those situations where they had such poor internal reporting. Their version of forecasting was looking at how much cash was in the bank in the morning, making some predictions about how much was going to come in and go out throughout the day, and what does the week look like. When Ryan and I talk forecasting, we're not only talking this year, we're definitely also talking next year. We're probably even talking longer term than that, which we realize you get too far out there, you're just guessing. But educated guesses could still help, provide direction there. And then this last one, or sorry, I have a dog barking in the background. Sorry. These last couple of things here: proactive, tangible operating equity planning. TOE is an acronym. Basically, it means how much equity do you have on your balance sheet. There are some dealerships out there whose OEMs require certain amounts of equity. This is not an issue for a lot of people right now. The last couple of years, even though we all thought COVID was going to possibly shut things down, people in the distribution and dealership industries, by and large, were deemed necessary industries, or essential industries, and so they were allowed to keep operating. And honestly, margins have held pretty well, even ticked up a little bit. Probably not as much as we thought they would, considering how supply is so difficult right now to get inventory and parts to sell. But the fact is, everybody's equity right now is higher than it was 2 or 3 years ago, which is strong. So strong balance sheets, but doing it throughout the year, proactive conversations helps plan that, and ultimately helps avoid surprises. I think everybody on the phone would say here, there's certain parts of my life I like surprises. That's called birthday and Christmas. It's not business, right? In business, we like to plan and at least have an idea where we're going. The audit can do that if you're doing it throughout the year. So with that here, I think that was our last slide. I'm going to flash up our contact information. Again, people are welcome to grab that information. Mark apologizes he couldn't be here, but I know he'll be on our future webinars here. We also have a series we call Stories from the Road. Here on the left, I want to encourage people to go to kco.com/subscription-center. And you can subscribe to Stories from the Road. And Stories from the Road is just a short, like 5-minute video series that we typically do 4 to 8 times a year. I would have always said 8 to 12, but then COVID hit. We couldn't be on the road as much. But I know Mark and I just filmed a couple of them last week when we were together at a conference. And really, it's typically Mark and myself. Ryan's joined us for several. Some other people have joined us. Special guests have joined us for several. And it really is usually just about 5 minutes on a topic about the industry as a good way to let people know what's the latest going on. Obviously, we don't share trade secrets, but when we hear multiple dealers talking about something, it kind of becomes the industry norm. So with that, I don't see any questions in the Q&A section there. Ben, if you're on the phone, I don't know if you had any questions come into you directly, but if so, we'll be glad to address those and give people a chance to type any more if they have them.
Sure. Thanks, Clinton and Ryan. That was wonderful. And yes, for any attendees, we did not have any questions come in. So if there's something that you are dying to know, feel free to type it in now and we can get to it. But Clinton, you and I were talking just before the presentation, and there were 2 things I wanted to ask you based on that conversation. And Ryan, I think you touched on this a little bit, so maybe there's not too much to add, but we were talking about when dealers typically evaluate having an internal audit function. I was wondering if you could just talk a little bit more about that.
Yeah, sure. I would say we kind of see 2 trends on that. One is it seems construction equipment dealers are much more likely to have an internal audit function than agriculture equipment dealers. That's not to say that there's any real reason to, other than construction equipment dealers do tend to be larger, faster. And so I would say the second thing is size. An internal audit function is not an inexpensive function. Even if you have one person on there, by the time you put labor burden on there, it's probably $100,000. And so that person, if you think about taking on that kind of expense, that person has to be adding more value than that, either giving you efficiencies or catching fraud or somehow helping you be more profitable. Because internal audit is not just how do I get ready for my external auditors. Internal audit, it really is more about operations. And so they can help drive margin and drive efficiencies. I did talk to a dealer a few weeks ago. They were only a 2-store dealer. I don't know where their revenues were. Knowing the brand they represent, I would guess at 2 locations, they were probably about a $50 million dealer, be my guess. And she told me they had an internal audit function. I was like, oh, really? Tell me more about that. And what it really was it wasn't a full-time function. So I think that is something that the people can keep in mind, is it doesn't have to be an all or nothing thing. You don't have to be a $500 million construction equipment dealer to have an internal audit function. Certainly when you get to that size, and on the construction side, we generally see it. But you might be a smaller dealer and just say, hey, I want somebody who does those things. But by the way, I'm also going to use that person, the other half of their job, to do X, Y, Z, a more normal thing then.
Sure. Great. Ryan, anything to add before we move on?
Yeah, I was gonna say that's pretty much the same thing that I would have said. When I've seen before, it's mainly operations. They're trying to make sure their processes are good, and they even have like meetings with each location that they would go to and look at just their store gross profits and have meetings with the different departments to, say, hey, this is what we're seeing. What do you see are contributing to this? So it even just starts a conversation on a more proactive basis within the organization.
Great.
Yeah, I mean, that's Ryan's example. There's a great example where that internal auditor can take the time to go through and find, let's say we have a multi-store location and a multi-store dealer, and you've got one store that's just outperforming on parts margin and one store that's way underperforming, and then 3 other locations that are all kind of in the same range. That person is the one who can take that time to go invest. What's the one that with a really higher margin? What are they doing differently? Now, to do that, they're going to have to understand what the group is doing, and they're going to have to understand what the one below is doing. And that's a great way where all of a sudden you say, man, that person can add value significantly, even by moving parts margin on the bottom store up to the middle and moving that middle group up 1 or 2%. All of a sudden they can cover that cost. Kind of along there, Ben, I think we had a question come in here talking about, what can add value to the internal auditor? Is it certification of their courses, that sort of thing. So there is a full-blown credential that out there called the CIA, which how cool would that to be able to say, I'm with the CIA. It's just as the way Ryan and Mark and I have the credential CPA, certified public accountant, there is a certified internal auditor, a CIA. Generally to do that, I don't know the requirements. I'm not one, but I'm going to say the requirements are probably a degree in accounting. I don't believe you have to have a CPA, although that probably helps get around some of the other requirements. But a lot of times there are specific college level courses that have to be taken to be able to take the exam. What I would say there is what we've also seen is people outsourcing that internal audit function to someone other than their audit firm. So that might be a way, in response to that question, that might be a way of, let me go hire a CPA firm that provides internal audit consulting, and then let me have somebody in-house who maybe doesn't have that big credential because they don't have the right schooling or the right time or whatever, but that person can still lead and drive those processes. I mean, they're not, I would say here, we're not doing brain surgery, right? I mean, a lot of it is learning. A lot of it, people that are good internal audit people come from operations. They understand the operations side as well or better than the accounting side. And then use an accounting firm as an outsource. We have a firm we do that. We've partnered with that on in a few instances. So I'm out of our Indianapolis office. Ryan's out of our Kansas City office. The firm we use for this, they're headquartered in Atlanta. And it's a great partnership. We've been able to work with them where they provide the internal audit support to our clients that we audit. We don't have any affiliation with them. We don't get referral fees back and forth because that can hurt independence. We just know they do good work, and we can then rely on their work. So that's another way to add value.
All right, great. Yeah, I was just going to bring up Natalia. Thank you for the question. Okay, we have 1 minute left. If there are no further questions, I guess I'll ask Clinton. We had talked about just real quick. When you find fraud, is it typically in accounting or operations? I know you said you have some examples there.
Yeah. I would say this one, we don't find it very often. In my whole career, I have found it one time in the audit, in the accounting function. It does tend to be larger over there. Really smart people with access to a lot of funds. Unfortunately, we did find it. That person obviously was terminated, and they turned over the investigation to the insurance company, who then turned it over to law enforcement. I mean, when we find it on the accounting side, I think Mark had, when he and I were talking the other day, he had said he had a different situation similar, but it tends to be a big number. Where we've seen it in equipment dealers the last several years, Ryan mentioned it earlier, is generally out in the parts area. Maybe somewhat related in the service area in terms of personnel, but it really is about parts. I mean, the machinery is so large, people aren't committing theft or fraud with big tractors and combines and that sort of thing. I mean, I guess you have theft, but probably not from an internal person. When we're talking about fraud, it is more on the parts side, so it tends to be smaller dollar amounts. Some of that can be done either through, like Ryan said, you wind up and find empty boxes, meaning somebody took the stuff out of the box and took it home with them and did something with it or sold it. Or we've seen it in the way that returns and credits have been processed. That's another area that, it's amazing how people understand that process. And if they know there's not a check and balance there, they can take advantage of it. But even at that, the dollar amounts are pretty small. They certainly do add up. Probably what's been interesting to us is, we think there's about a 7 to 10 year cycle through the ag economy or the construction economy. And they both had a really good run here recently. But even in some of those down years, we would have expected more fraud in down years than in up years. And I would say this, again, we don't run into it that often, but we don't see a significant difference in it occurring because the economy is good or bad. I think what it really gets down to is just bad people do bad stuff, whether the economy is good or bad. I think it's maybe a misnomer to think, oh, the economy's good, people won't do it, or the economy's bad, they're going to. I think it's less about that. So yeah, it's interesting stuff there, Ben.
Yeah, great. Okay. Well, I don't think we have any other questions. I did miss this in Natalia's question. Will the presentation be shared? I don't want to put you guys on the spot, but if Natalia emails either of you, would you be able to get the slides?
Yep. Yeah, that'd be perfectly fine. Shoot us an email. The video has been recorded also, so I think people are welcome to go back and watch the recording. But yeah, if you want the actual slides, or we put them in a PDF format, just send Ryan or myself, either one, an email, and we'll get them to you.
Wonderful. And the recording, you're correct. The recording will be available. Okay, well, I think we can wrap it up there. Thank you, everybody. And again, there will be a recording available at a later date. So on behalf of myself, Clinton, Ryan, and Keiko Isom, I want to thank you for joining us today. Feel free to reach out and let me know what you thought of the live event or any other topics you'd like us to cover at some point in the future with other webinars. So thanks again for joining us. Thanks, Clinton and Ryan, and everyone have a great day.
Thanks, Ben.
Thanks.
Thank you.